Trading, in its most basic form, is the process of buying an asset at a relatively low price and then selling it later at a higher price, aiming to make a profit from the difference. Essentially, trading is about capitalizing on the natural fluctuations in market prices to generate income. Although this idea sounds straightforward, buy low, sell high, the reality of trading is much more complex. It requires careful strategy, thorough analysis, and disciplined risk management to be successful. In simple terms, trading is like a game of timing and decision-making, but it's definitely not about luck or making random bets. A good trader relies on informed decisions supported by various tools and techniques. For example, technical analysis involves studying charts and historical price data to predict future price movements. Meanwhile, fundamental analysis focuses on evaluating the underlying value of an asset by looking at economic indicators, company performance, or market conditions. Understanding market behavior, how news, events, or investor sentiment affect prices, is also crucial. All these elements combined help traders minimize risks and maximize potential gains. To make this more relatable, imagine you're a fan of Pokemon cards. One day, you decide to buy 10 packs of cards, each costing $5, spending a total of $50. A few weeks later, one of those packs becomes highly sought after by collectors because it contains a rare card. Someone offers you $20 just for that single pack. You invested $5, sold it for $20, and earned a $15 profit. That's exactly how trading works: spotting opportunities, buying at a good price, and selling for more. This concept applies not only to Pokemon cards, but also to financial assets like stocks, cryptocurrencies, foreign currencies, and commodities. Trading is not restricted to just one type of product or market. Today, thanks to technology, you can trade in a wide variety of markets from virtually anywhere using your computer, smartphone, or tablet. The most common markets include stock market. Here, you buy and sell shares of companies like Apple, Amazon, or Tesla. When you buy a share, you're essentially purchasing a small piece of that company, hoping its value will rise over time. Cryptocurrencies. Digital currencies such as Bitcoin, Ethereum, and many others are traded globally, 24/7. This market is very popular due to its high volatility and accessibility. Forex, foreign exchange. This is the largest financial market worldwide, involving the exchange of currencies like the US dollar, euro, yen, and others. Forex trading sees trillions of dollars exchanged daily and operates around the clock on weekdays. Commodities. Physical goods like gold, oil, natural gas, and coffee are traded as well. These markets are influenced by global supply and demand, geopolitical events, and economic trends. Let's consider an example involving cryptocurrency. Suppose in January, you bought one Bitcoin for $20,000. Over the next couple of months, the price climbs, and by March, Bitcoin is worth $30,000. You decide to sell. Your buying price was $20,000, your selling price $30,000, so your profit before any fees or taxes is $10,000. Millions of traders around the world make similar moves every day. The key to successful trading lies in learning how to spot these opportunities early, managing your capital wisely, and accepting that losses are part of the game. Markets can be unpredictable, and prices don't always move in your favor. In summary, trading is a skill that combines knowledge, strategy, and discipline. It's not a guaranteed way to get rich quickly, but with the right approach, it can be a rewarding way to grow your wealth over time. Whether you're trading stocks, cryptocurrencies, currencies, or commodities, the fundamental principle remains the same. Buy low, sell high, but do it smartly. Everything starts with learning. Before putting real money into the market, it's essential to understand how trading works. And that's exactly what you're doing right now, learning. Many people make the mistake of jumping in without even knowing the basics, and that usually ends badly. Fortunately, today there are many tools to help you learn without risking your money. One of them is demo accounts, also known as simulators. These platforms allow you to practice with virtual money, like a video game, but in a real market environment. With these accounts, you can buy and sell assets as if you were doing it in real life, but without losing a single cent. This way, you gain experience, understand how prices move, how to place buy and sell orders, and how to react to market behavior. It's like learning to drive in a simulator before getting behind the wheel of a real car. The next step is to open a real account on a reliable platform. Once you feel more confident, you can open an account with a serious and reputable trading platform. Some of the most popular and widely used platforms around the world include Binance, specialized in cryptocurrencies, eToro, very beginner-friendly and with copy trading features, or Interactive Brokers, more advanced and professional. What matters is that the platform is regulated, has a good reputation, and offers educational tools. Start with a small amount of money. Many beginners make the mistake of putting in all their savings, hoping to get rich in a few days. That's not trading, that's gambling. In reality, you should start with small amounts, just like learning to ride a bike. At first, you use training wheels, go slowly, and fall a couple of times. But little by little, you improve, and eventually you can go faster and with more confidence. It's the same with trading. It takes practice and patience. Don't guess. Use analysis. One of the most common mistakes among beginners is getting carried away by emotion or by what they hear on social media. For example, they see something is trending or that many people are talking about a cryptocurrency, and they buy without thinking. But trading is not about guessing. It's about analyzing. There are two main tools: technical analysis, which studies price charts and patterns, and fundamental analysis, which is based on news, economic events, and company data. Let's suppose your friend tells you, buy this crypto, it's going to skyrocket. You trust them, buy without researching, and the next day the price drops. Why? Because maybe it had already gone up too much and now many people are selling. Result, you lost money. These kinds of situations are very common, and the only way to avoid them is by informing yourself and learning to make decisions on your own. Yes, trading can be a way to make money, but you can also lose it, and quickly. This is not a promise of instant wealth. In fact, many beginner traders lose money at first. That's why you should never invest money that you need to live. If that money is for rent, food, or basic expenses, don't put it in the market. Only invest what you are willing to lose. It's also normal to make mistakes in the beginning. What matters is that every mistake becomes a lesson. Don't beat yourself up for messing up, use it as a chance to improve. Start with a small amount of money. This reduces your risk while you learn. Learn from your mistakes. Keep a record of your trades and analyze what went right and what didn't. Never follow advice blindly. Always do your own research before making a decision. Use simulators before using real money. They let you practice without risk. And most importantly, be patient. Success in trading doesn't come in a week. It's a process. The more you study, practice, and improve your strategy, the better your chances of doing well. And now that you know what trading is, would you dare to give it a try? If you'd like me to make more videos with simple strategies for beginners, or if you want to learn about cryptocurrencies, let me know in the comments. And don't forget to subscribe for more clear and direct content about the world of money and investing.